Hello, everyone, and welcome to another ACY Securities webinar. To get started for tonight, there are a few things I have to go through beforehand. I am trying to start as on time as possible, but I was a rush to get to this point because my computer decided to do a restart right before we were meant to start. So I have got everything all ready to go. And to go through some of the things we're going to be covering tonight, I will go through the first thing. So the first thing is, my name is Alistair Schultz, and I'm the Chief Market Analyst for ACY Securities. So for those of you who might be new tonight and haven't experienced a webinar with ACY Securities before, a little bit about me to sort of get it kicked off is that I've got about 15 years of experience, probably even a little bit more now, close to 16 years. And my experiences have ranged from all over the place. So there's been trading floors of New York. I've been in boutique funds and investment management sort of firms, including institutional and retail side of things. And these days I'm working obviously for a broker at the moment. I'm also a published author. I wrote a book a couple of years ago. I'm currently working on a second edition to give it a bit of an update at this point in time. And initially I wrote the book for some of my own students. Which I had at the time. And these days, I suppose the most well-renowned student that I've got is actually Tim Cahill, but I have a variety of them that are now still working in the finance industry, whether that be trading full-time or working in some other capacity. Outside of that, I do a lot of stuff on TV-related services, AusBiz TV. I've been in the AFR, Sydney Morning Herald, Bloomberg, FX Street, Finance Magazines. There's quite a few different places that I am commonly seen. And so, of course, I also do all the hosting and podcasts and YouTube channels for ACY Securities. So if at the end of this session you decide you want to get a little bit more and decide that you feel like you need a bit more, then I do host a whole stack of educational content on our YouTube channel. So feel free to check that out. Now, moving on to the bits, the nitty-gritties that are sort of important for tonight. If you are intending to get in contact with me, I encourage everyone to sort of bring a chart with them. You don't have to bring a chart. If you don't have a chart in mind, then it doesn't matter. I'm quite happy to work with what I've got. But of course, if you want a second opinion or you want my eyes on it, then I will try and mark up what I'm seeing on the chart from a technical perspective to begin with, and then we'll move into a bit of a round on the side of fundamental analysis. Now, if you want to put a chart up, I do ask for it. If you are watching through Zoom, it's quite easy. Just run onto the chat box, send me a message through there. There are a couple of shortcuts that I've got up on the screen for you now that will enable you to open up the chat box if you're not quite sure. So if you're on a Windows computer, it's Alt plus H. If you're on a Mac, it's CMD, Shift, and H. And if it's an iPad, Command, Shift, and H. So you have a couple of options there. Now, unfortunately, if you are watching from YouTube, then I'm not really able to sort of respond in the chat box there because we've got all of this sort of going on. I'm trying to manage Zoom as well. So I do ask that if you are watching it from YouTube, that you please leave a comment in the comment section and I can respond to you quite quickly. Otherwise, feel free at the very end of the session, I'll give you some ways to get in contact with me and you can send me a message if you need some further clarification. And of course, sometimes you might need a little bit of time to think about your question. So if you don't have one right through this session, feel free to send me a message on the alternative means. Now, moving on to tonight's agenda. Last night we had the Federal Reserve make some announcements, talk about their economic projections and so forth. So I thought it'd be a good idea to recap them. We did speak about what some of my expectations for them to do were on Tuesday. So I figured it would be a good idea just to have a bit of a revision of that and to have a look at some of the charts that the movements have actually occurred on. Outside of that, we're going to have a quick look at the Australian unemployment scenario. And I will also have a bit of a look at the Bank of England, though, which is on for tonight, but I'm not entirely on the grounds that there's going to be too much action because we've already seen a fair bit quite recently. And I feel that some of those changes may be a little bit too early for the Bank of England to be handling. Now, of course, if we have time at the end of it, some of your charts and questions as well. But please let me know your charts that you want to have a look at earlier on in the session. The earlier you let me know, the easier it is for me to sort of put it all in and fit it all together. And then that way, no one sort of runs out of time or we're not missing anyone else's chart either. So let me know how you go on that side. Now, before we get into it properly, I do have to provide you with a risk disclosure warning. This statement here that I've got on the screen right now basically says that anything that I do say tonight is not to be considered personal advice. I don't know your personal financial situation, so I can't do any sort of recommendations on that front. But it is from a generalized sort of perspective, and I usually talk to things about my own scenarios and what I'm doing in that necessary. Now, of course, if you are also, this is probably an additional bit, but if you are not sure of your investment objectives, you're not sure what your risk tolerance levels are or your own trading experience levels, then I would recommend that you actually do seek some advice. Of course, if you need someone to point you in the right direction, then let me know and I'll try and give you a hand on that front and put you in contact with someone who'll be able to help you a little bit more. Now, moving on from all of that, we'll come back to this later. I'm just going to put up a chart for us to have a bit of a look at to begin with. Now, we have had a fair bit of movement in the overnight action that's gone on. I am just going to sort of see if I can go show all on this and see if we can get a dollar index chart up. Yes, here we go. Now, we've got the dollar index here, and it gives you a bit of an idea on where prices have been moving. 5-minute chart's not so useful for us, but the hourly is. Now, this is where the Federal Reserve did some damage there last night. So before we sort of get into that side of things, I'll give you probably a little bit of a wrap up of what we've seen so far. So the first things to sort of have a look at is the NASDAQ. Now, we've seen it sort of dropping a little bit today. The futures have dropped down a little bit on those benchmark treasuries as well. So we've seen sort of some of the highest levels are easing back away from everything at the moment. The US markets kind of looks a little bit poised to do a bit of a reversal on quite a variety of different things. We've had the S&P 500 hit a new high. We've had the Dow Jones hit a new high. And the NASDAQ's really the only one that hasn't, but that's because it's been more related to what's happening with bond markets. Now, when we sort of look at what's been going on in the overnight action, which we will get into, we've heard from Fed Chairman Jerome Powell, and he's basically said that central banks are not going to be raising rates until they see some form of tangible evidence that the US economy has effectively fully recovered from all of its problems. Now, the news from the Fed has affected a number of other markets as well. Obviously, we can look at a few different indexes, which would be a good place to give us a bit of a snapshot on how it's done. So the Nikkei is one that I like to have a look at as well. We'll put it on a bit of a daily so we can see. We've seen it traveling up today in the ticks of these last two sort of bars. We've also seen some sort of action around other Asian markets, some of them including like the Nikkei indexes and things like that, which I don't actually have available on this platform that I've got right now, but we can certainly have a bit of a look at it elsewhere. Now, to me, it sort of seems that investors appear to be somewhat reassured by what the Fed's current phase is going on about. They're going to be giving continued policy support. And I think realistically, markets have been bracing for a more hawkish tone. All of the stuff with bond yields has been giving us a little bit of cause for concern. And particularly on the inflation side of that, everyone's been thinking, we're going to be starting to get a taper. And this time around, that's not happened so much. So, it's kind of spurred a bit of a rotation from growth stocks into value shares. And I suppose the market reaction sort of suggests that investors are kind of satisfied with what the Fed's explanation is for now. Now, nonetheless, inflation is still expected to rise in the coming months, and the Fed may need to tweak some of its hand-holding exercises with the market to try and sort of avoid having some of these bond yield spikes and obviously causing turmoil in markets. Now, outside of all that, the other ones that I was paying attention to today, we'll come back to the Aussie to have a bit of a look at that in a minute. I might just leave it on another chart so that, yeah, there we go. We'll use this one. Now, the other one to look at is oil, specifically US oil. And there's a couple of things with oil that are going to be interesting this month. There's oil there. Now, US oil has come down, and usually you would see US oil and UK Brent moving in pretty similar patterns, but obviously, we'll put them on the same time frame so it's a bit easier for us to see. Usually they move in pretty similar tangents. WTI moved much faster than what we saw in Brent today. Now, this is an observation. You can't sort of tell from just looking straight at the chart side by side like so. But on the actual move, it was quite delayed on the Brent side. And the reason for that is that we've seen US crude stockpiles hitting 500 million barrels. So that's kind of like a lot of supply than what's really needed. Supply is actually quite plentiful. So we've seen prices sort of starting to come down on that front. Now, there is one other caveat to consider, and this is probably more for the 29th of March. And I'm just going to bring up the thing for it so I can give you guys a bit of an idea on what I'm looking at. Now, I've got the ICE exchange, which is the Intercontinental exchange for futures. And there's a new crude contract coming out, the Murban crude oil futures. Now, this oil comes from Abu Dhabi and the United Arab Emirates. So they're making a new contract that's going to function in similar ways to West Texas Intermediate crude oil. And in West Texas Intermediate crude oil, it means that you can effectively buy a barrel of crude and you can send it or sell it to anyone in the world, and they will pay the shipping and handling, and it'll get to them. And you don't get the same sort of flexibility with some of the other oil futures contracts out there. You would have to send someone to go get it or that sort of thing. But with this, Murban are planning on doing the exact same thing. Now, this isn't opening up until the 20th. It doesn't get added to the ICE exchange until the 29th of March. And it does have the capability of really upsetting the oil market, if you will. You know, there's a basket, especially with OPEC. OPEC and Abu Dhabi has usually been a part and a bit of an ally to Saudi Arabia, and they have not been sort of seeing eye to eye for quite some time. So this is the result. And whenever you get futures markets and in this sort of fashion, they really upset cartels in the fact that, you know, if they push hard enough, you might find that a cartel disband because of things like this. It's not the ultimate way of sort of dealing with things and controlling pricing. So, you know, this contract actually does serve the capability of undercutting the prices that we see in current WTI and UK Brent, and of course, you know, the mixed bag or barrels that we get out of the Arab nations. So, you know, this it does pose a bit of a threat to the current stability that we've got in oil prices. And it's going to be an interesting time to keep an eye on for the oil side of things in the near future. So moving on from that, we might also, just before we do get into sort of the Federal Reserve stuff, you know, calendar-wise for tonight, just to give you guys a bit of an idea on what, you know, I'm thinking is important. Now, this was the FOMC announcement that we saw last night. It was 5 a.m. this morning. I was up at about 4, having a bit of a trade on it, and then off to work. And then now we've also had the employment figures come out, which have been positive. We've seen some pretty good drops on that. So we will talk about how that's probably going to fit into the picture, particularly with JobKeeper subsidies and what we might see for small businesses. And then, of course, tonight, 11 p.m. Australian Eastern Standard Time, we're going to be seeing the bank rates for the UK. Now, at this stage, there's not a lot of expectation that there's going to be any major changes coming. I don't personally see them wanting to do too much. They've not long done the budget. They've also got vaccines still rolling out. They obviously got quite a good placement to sort of start getting the economy back on track. They've only just ended lockdown. So, you know, there are a number of reasons for them wanting to keep the same pace of asset purchase programs, keep the rates low where they are, and try not to make too much change or rock the boat a little bit. Doing too much damage now or making too many big changes now would ultimately affect them over a much longer period of time. Also, we can't forget that, you know, Brexit is really still only early days. So let's get on to the first sort of side of things that I've sort of looked at. When we think about what the Federal Reserve has sort of initiated today, you know, Jerome Powell and his colleagues have continued to sort of estimate or project near zero interest rates, at least until 2023. But it sounds like it's going to be towards the end of 2023. So in reality, you know, that means that we're not going to see a rate rise until 2024. And I suppose that's given a little bit of confidence back into the markets that we've been dealing with on a variety of pairs. This was the move. So on the Aussie, we saw, you know, a 97 pip candle for it. On an hourly chart, obviously, if I change the time frame, you still get quite a few big candles happening in the middle of that. We also saw it happening on the dollar yen, which, you know, any dollar pair that you had, you know, you could look at it on the euro dollar as well, and we get the same sort of effect happening. Here it is again on this one here, in case you're just curious. We've also seen it on the pound dollar, the euro dollar, the Aussie dollar. We've already been through. We saw it on gold. As well. And for gold's reasoning, it's because of the inflationary aspect. It's though it's not nearly as a spectacular looking candle, but it certainly provided us with a nice head and shoulder pattern a couple of hours later. So, we are still getting some of these nice patterns that we like looking at when we do see them. And even sort of things like the dollar yen. Now, the one thing that I do always have to sort of explain for people that might be new to trading is that when we see it on something like the dollar yen, when I can actually find the trading pair popping up in my thing here, which I'm escaping my eyes, it will turn up eventually. Maybe it's on the top side up here. There it is. Now, on the dollar yen, whenever we get sort of moved, and this is all based on your base currency and your quote currency, if you've got the US dollar on the right side of this equation up the top here, then you will generally find that adverse news for the US will mean that price will rise because you're getting a weakening of the US dollar. And when it's on the opposite side, when you've got the US on the left side, it means that it will go down. So bear that in mind when we look at certain things. This is a not a bad looking sort of shape starting to appear now. You could call this almost a bit of a double bottom, but it's, this wick is the one that bothers me and leaves me less confident of it actually performing. Now, thinking about the decision that's sort of come in, it's been a very volatile day for today, particularly with, if you think of the last couple of weeks, we've been hearing about treasury yields surging all the time. Right before the announcement today, treasury yields sort of spiked again. They hit about I think Australian ones, 10-year yields hit 1.83. And we saw the US one sitting up at around the 1.65, 1.7 mark. So, those are very fast numbers to be approaching, this early on. And so we effectively saw a base lift off. But, Fed Powell has stressed that, it remains a minority view that this is bad for the economy. And they are looking at the idea that inflation is what they want. And that it shows some sort of sign that there is optimism in the market. Now, this is something that I wanted to show you. I've kind of just pulled this up. I was looking for it whilst we were talking. This is what we call a dot plot. And this is something that was introduced in 2011 for the Federal Reserve. And it was introduced by the previous, the previous Fed chairman, which was Janet Yellen. And this dot plot, basically, each one of these dots is a Fed official voting. And when they make these sort of voting, it basically says, you can sort of summarize already that, if we're looking at 2021, beginning of 2021, FOMC members projected that in this year there would be no rate rises from where it currently sits. And they all unanimously agreed. In this period, when we move into 2022, the majority vote that there's not going to be a rate rise. Then we have 3 that vote that it'll probably get to about 0.25%. And then we've got one individual that says we might consider going up to the between 0.5 and 1% interest rate sort of hikes. And then in the 2023, it's the same sort of deal. You're getting 1, 3, 2, and it moves up. But then, these are very small, and they need to be voting basically unanimously to get the results that they're, to get any actual change to happen. So we can see that, 2021, there's not going to be a rate change. 2022, you've got 4 people out of 17 that are considering it. So that's never going to happen. When we get to 2023, we do start to get a few more on the outliers. But for the longer term picture of 2024, the long term, end of 2023, beginning of 2024, there's a lot more. And last time they did this dot plot, it's almost identical every single time, but there's always one slight variation. Last time it was in December, and there was only 5 of the dots at this level here, which means that 2 people have added to the list. The more we see people jumping onto this, so that's still a potential possibility. Whilst they present right now, it's not going to be until 2024 that rates raise. If there is enough systematic evidence that suggests they need to actually do something about it, then you will likely see these dots change. And this isn't the best way to sort of look at everything. It does give us a little bit more information, but it's not a great indicator. It doesn't tell us who is voting. And obviously, if you've got, the chairman voting in this range, then you sort of know that his vote will probably sway quite a few others as well. And that does give us, a little bit of a reason to sort of doubt what might actually be going on to a certain degree. But it doesn't mean it's going to be the case every single time. And those dot plots, whilst they are handy, you've got to take them with a bit of a grain of salt. So that's definitely something to consider. And what we've heard really from the Fed is that, the indicators of economic activity and employment that are turning up, though most sectors are being adversely affected. So a lot of sectors, such as certain elements of the retail sector, certain elements of materials and manufacturing, and anything that was close proximity, and think of all the things that have affected your own countries or your own livelihoods or wherever you may be in the world, that have had to shut down and lock down, cafes and hospitality and all that sort of stuff. That they're still getting a lag in it, and so they've basically put their foot forward. The Fed has said, we aren't going to raise rates. We're going to let inflation run hot and see how hot it can actually get. And our focus is entirely on employment scenarios. So that is what we're really dealing with at the moment. And I suppose to some degree it gives you a little bit of confidence that the Fed is going to continue to support the economy for at least the next couple of years. And until we see some of those numbers popping up, and a more even distribution of inflation across the entire economy, then we are probably going to be okay. Be waiting around for then. The other one to sort of consider about in inflation, and this is something that I was talking to a colleague of mine at another firm not too long ago. We were saying, that we are really already seeing signs of inflation through asset pricing, particularly in commodities and materials and resources, but also in even things like GME, the stock, and of course, Tesla and things like that. We're looking at those as, the value of them is being a little bit skewed because of, such low rates really affecting the value on how we might apply a DCF model to a valuation of a company. So we are sort of already seeing issues on that front. Now, having a look at a little bit more, I suppose when we look at the charts, what we've seen in the action that's come on from here, this sort of action, when you get a big move like this, you can look at it from one of two ways. The first one is we can look at a chart where we've seen, a spike and think, oh, okay, we're going to wait until we get some new data that will suggest us some new information, or we can go to a longer time frame and try and look to a point where this big line becomes inconsequential. To a degree, this is kind of like noise now. It's pumped price up, it's shifted the market to the direction it needs to go in. And so the easiest way to get around that, if we're going to a 15-minute chart, you get more candles. So you can either add the noise into the chart so that you have more, bars that will give you a bit of a better idea of where things are going, or you can do the opposite and remove some of those bars to give you a different picture or layout on what you're actually paying attention to. Generally, when it comes to the sort of dealing with these sort of scenarios, you quite often will find that people will try and sit on their hands, and you will also see that people will try and go the opposite direction. So we don't want anyone to sort of lose their funds or do anything in the wrong way. So if you're ever in doubt, you kind of just do nothing and keep an eye on seeing what happens, because that's the best course of action when you're not entirely certain on what might be actually going on. Now, when we think about the Fed side of things, the Federal Reserve is going to continue to hold their course. They're maintaining a glide path for basically both rates, asset purchases that they established there last year. And it doesn't appear to be close to altering its trajectory anytime soon. And that leaves us with, the asset purchases being left at $120 billion per month. And they're going to maintain that until there is much more progress going on. So what does the progress side look like? That means they want to see unemployment figures below 4%. And that's really what we're going to be paying attention to over the next coming weeks. Now, thinking about our charts. Now, if anyone does have a chart, let me know now. But I will be going through the Aussie as one of them. We might have a look at the pounds and the euro. We've already looked at the WTI sort of stuff to a certain degree. I'm still sitting on. I'm really keen to see what happens on the 29th of March for that one. We'll have this one up here as well, and we've got some decent price action sort of happening at the moment. So I'm going to try and keep an eye. The pound dollar is going to be an interesting one for tonight. Because I am super speculative on what they might be going to say. So we will come back to that once we've gone through the sort of US sort of market action. Now, thinking about the Aussie dollar, because it's all kind of going to be integrated now, we've seen the unemployment figures dropping down to 5.8%. So that's giving us pretty good signs that we're seeing recovery starting to pick up pace. And that's what we want to see. Now, when we, I've got these lines on this chart from, I believe it's from on Tuesday, as some sort of areas of support on the bottom side, resistance on the top, we can add to. And, we could simply drag a line up that side. We've already seen this was the one that we had on sort of last week or so, and price has actually touched on it and is holding its ground against it. The next point is obviously the 80-cent range. So we want to know, is the Aussie going to keep on going in this direction and try and test this 80-cent range? Looking at the dollar index, which we had up there before, we can see that there is some sort of changing. This is a great way to sort of think about things. If you've got the dollar index going down, it's weakening. That means, this dollar index chart takes a picture of all the other, Aussie dollar, pound dollar, euro dollar, dollar yen, takes the US component of them and gives you a bit of an average on where the US dollar sort of pricing is going. It's a little bit more complicated than that, but it does sort of fit in that kind of scenario. Now, you can trade a dollar index chart, but you're going to have to be using futures. Otherwise, I would be wanting to place a trade on this pretty much now. This is the only concern, a wick that is longer than on the second leg than the first leg. But ultimately, this basically looks like a bit of a double bottom pattern to me. You've got your bottom range, you've got your entry point. You would then double your distance from here, which would be about 21, putting us up to about there. And that would be roughly where your take profit target is. The engulfing candle on this side is quite a generous sign to sort of see. Plus, the resistance back over the entry price indicates that other people are thinking sort of the same thing. Now, looking at this bit of the wick is where you sort of go, okay, well, I'm not as confident now because we know that price can go lower. So you wouldn't, necessarily want to take that position every single time if you did see it. But I thought it'd be useful to sort of look at right then and there. Now, whilst that's all the case, the dollar index is obviously coming back down again. It's not the worst it's ever been. If we were to zoom it right out, the worst we've seen so far in the last year has been about an 89. So it's not that far different. 89 to 91, it's still pretty weak. And the fact that it's sort of moving back down this way again says to us on this Aussie dollar chart that there is probably going to be more strength for the Australian dollar than there is for the US dollar at the moment. And that's something to consider. So when I was talking about the base currencies and quote currencies before, US dollar on the right means that if we get a weakness in the US dollar, then this chart is going to aim to go in this direction. It's going to aim to go up. So what can we do to start off with? Well, we've already got these lines in place that I think are going to be quite useful to us. The next one I'm going to put is I'm just going to put a trend line like so. And this is basically kind of like a target range line for me. We can use this as a bit of a guiding tool for us. You could also fit it up across the top side, and provided this candle that finishes now stays sort of looking a bit like that, it's okay. We've got a bit of an upgoing trend channel to try and trade our way through for the time being. Now, what are the parameters that would cause concern for a long position failing in this sort of scenario? Obviously, looking at it from any time frame or chart is irrespective of what we might actually see from the Reserve Bank of Australia or the RBA. Now, we already know the RBA does not like a strong currency. Last time was at 80 cents. They shot it back down. The time before that, same sort of deal. And the way that they do that is by increasing their bond purchases to try and create more money supply and availability. They're basically printing cash to try and reduce the amount of the value of the currency. The reason they do that is because the more expensive or the stronger the Australian dollar is, it makes our exports less and less competitive. And there are other countries you can go to where you get a better exchange rate and get the same amount of goods. So that is why we sort of do it. And it's usually from this point on that there's a bit of a risk. And I'm sure that when we saw, today the RBA would have been sitting there going, damn, it's happened again. And they're going to have to come up with some sort of a reason to try and push it back down. We're very likely going to be hearing from Governor Lowe, which is the governor of the RBA in the not too far distant future. And he's going to try and jawbone this down, or he may even just skip the jawboning step and go straight to actually, pushing it down a little bit. So, that is one element to sort of consider. Adding into this sort of woe for the picture, I mean, we're looking at sort of scenarios a little bit further down the track. But, if we were to look at what might be happening from the the employment scenario, we're going to be seeing JobKeeper end soon, which means that there's probably going to be business failures in the small to medium enterprise side of things, where they've been receiving wages for employees to try and keep them open. Obviously, a lot of companies have also been able to amass a huge amount of cash because of this program, and that's some of the failures with trying to roll out a program such as that in huge quantities of cash very, very quickly. But that's neither here nor there, or part of the discussion today. Now, looking at a chart that we do have this upgoing trend channel. We are seeing, we've got at least 2 contacts on the bottom, 3 almost on the top. The current candle is giving us a bit of an indicator that it perhaps may want to come down a little bit. Looking at it from an hourly perspective, we've still got this jagged sort of feature. We get period of consolidation and spike up, and then now we've got this nice engulfing candle happening. So what would I like to see in this immediate moment that might make me want to place a trade? I would like to see some form of consolidation that occurs basically from now across out over this way like that, within that sort of box. I would then like to see price push down below this point here. If I can get price to push below, the lows on this one, or even there, these 2 sort of points, and to close below them, somewhere in that range, then it would start to look a little bit like a head and shoulders sort of pattern. On a 1 hour, obviously zoomed out, it's not quite so respective, but if we were to then get it happening on this side as well, then it becomes a little bit more mature for us to be able to deal with it. Now, if that was to occur, then the plan of action would be stop loss on my top side near this line of resistance, probably on the other side of it, and then I'd be looking for a position that would be sitting about 60 pip away, which almost takes us to the bottom of the run. Now, realistically, there's not a huge deal of news going on right now that we can deal with on the Aussie dollar, because we're after market hours for that side of things. There's no Australian side. US market still isn't open yet. So the effect that we're sort of seeing now is what we've gotten from the UK counterparts starting to kick in to gear, because it is about London open roughly nowish, and overlap perhaps give or take an hour, and we are sort of waiting for their sort of moves to take the next steps. Now, if we keep maintaining a position up here, we want to stick with the trend. Usually, trend is your friend. So you're going to be wanting to look for long positions within this trend channel, ideally from the lower half of the channel down this way instead of on the top side. But if it's on the top side, there's no reason why you can't use a smaller risk position. So, a much smaller lot size or something along those lines, and aim for a position to sort of come back down this way with a very tight stop, on the other side of this top side of the trend channel. Dropping us down to a 15-minute chart, we do get a little bit more evidence that suggests now, if this current candle here that we're looking at, the red one, was to close below here, or even now was to close, you consider that an engulfing candle. An engulfing candle is a candle that goes at least 50% of the way into the previous candle and closes. But generally, I like to see them be bigger than the previous candle, and that's what I call a real engulfing candle. So this becomes a little bit more useful for us to deal with. Now, when we think about this Aussie employment sort of situation, the idea of seeing strong employment picking up is quite good. We've seen improvements in March, we've seen them in February, we've seen them in January. We've now got vaccines rolling out. So overall, the Australian situation is likely to continue improving. The only subsidy side of that, or the only problem that sits with that, is obviously the subsidies that come from the JobKeeper payments, potentially putting some businesses out of business. But in all honesty, there would have been a lot of businesses within that circle that may have failed had they not had JobKeeper. And of course, even if we didn't have a pandemic, there would have been a lot of companies that would have failed anyway, generally speaking. So, obviously that's not a nice thing to say, but it is a reality of what's actually happening. So if we can take that sort of element and take it with the grain of salt, and we also look at the RBA's limits on wanting to sort of push currencies back down, then the next couple of weeks are going to be pretty interesting for the Aussie dollar. And I've got my own personal aims to see it hit the 80 cent range up here over the next couple of weeks. But of course, if it doesn't, then I will be reevaluating my position. And I would also consider that if it is going up sort of this direction and going for the 80 cent range again, that the RBA will be very actively watching it. It would be probably about the 79 cent mark that they start talking about talking the currency down. But you can see just how far, an 80-cent run can actually, how quickly it can happen. We've got, this is on a daily chart to give you a bit of an idea. We've only been, 2 weeks since it was at 80 cents last time. So, I would expect to hopefully see it move back up this way. Evidence-wise, even from this perspective, we've got a bit of an upgoing trend there that we can certainly use as a alternative line for a bit of a longer-term picture as opposed to the immediate moment. So there would be your other one, as at least on the bottom. Doesn't fit so perfectly on the top, but you've got higher high. Currently, we're sitting in the range that could be, the next run up for it. But I would say that we're going to be just waiting to see how it goes. And from a bit of a, this sort of looks, a bit like a reversal style pattern. So, you could quite easily run this as an entry point right now, a stop loss at about this point, and then try and aim to reach, somewhere up around here if you want to go for a bigger position, at least off a day, a small position, but a lot more in terms of time or time horizon for it actually playing out. Now, 5-minute charts don't, generally just give us a little bit more noise. I do like the look of this for a short position right now. If price can cross below here, then I would be considering a short position pretty much now, or waiting for it to sort of get below here. Ideally, I want to see current candle or the next one close below here and at this range, and then I'd happily look for a short position of about 8 pip off a 5-minute chart to sort of consider. Now, euro dollar position, same sort of deal, going up and down really with where we're going. This is the move that we had from the Fed overnight. I'm not as positive about the euro at the moment in terms of strength against the US dollar. They have got very little in the way of vaccine rollouts. AstraZeneca vaccine has basically been banned for them for the time being. They are still potentially entering lockdowns. They have used more stimulus to try and control those lockdowns, but they aren't releasing it. So there is a fair bit of evidence to suggest that we might and continue to see the euro dollar moving down. The current pattern that we're seeing right here certainly suggests that. Again, here's your sort of entry line, your stop loss, and I would be looking for a position of about 30 pips. So, aiming for about here at this point, 1.19235 is my first intake. It's also where you get a nice level of support. So it would be the prime sort of place for it to get stuck at. And we're also seeing it getting stuck right now at the previous one. So if we bust through this layer of support here that we're getting at this point, then the next stop is going to be in and around the bottom of this range here that we've got there. So that's really the sort of anticipation for the euro dollar. Dropping us down to sort of a 5 or a 15-minute chart gives us much more evidence that it kind of works. It's on the border. Ideally, this one I want to be a bit lower than this side. This does, however, give us a nice little crown sort of shaped pattern, which has played out. So, if you are looking at charts in the future and you see this sort of formation where you get a number of wicks going on the top and it kind of looks like a king's crown, then you can look for positions on either side of that. Now we will have a quick look at the pound dollar to sort of wrap things up and sort of have a bit of a thought about that. Now, I don't mind the look of that for now. If this comes down a bit further, there's a lot of patterns out tonight, but the daily chart is and the 4-hour chart is where we're sort of looking. Now, this is something I sort of put up a little bit earlier last week. Now, when I think of support and resistance, for some of you who might be new to it, the bottom line here, I'll change the color, make it easier for us to sort of talk about. This. Let's make it green. Okay, so this green line is really the actual trend line that fits. But the pink one is just a direct copy of that. They are identical, just I've moved one up. And you can move them up quite a bit. So, I can I can move another one up sort of over here, which will fit kind of okay. You can put one even a little bit lower, but it's sitting right through the guts of price. You never want to sit through the guts of price. And whilst, these lines, they are just simply lines. When I use two like this, I sort of look at this area as a bit of a zone of support or resistance, as opposed to, one line being static, because it never works quite perfectly. It is just a line at the end of the day. And they do give us a bit of a nice guiding point to sort of work with. So, when I look at this sort of area, I look at this as a zone of support. Whenever price comes into it, we get a bit of a pull out of it. And right now we're sitting right on a line. We have a bit of a pattern sort of showing up on the daily chart as a double bottom here. And ideally, in this sort of position, we're looking for about 200 pip to come up. So, I'm quite okay with this as a continuation going on. We've got US dollar weakness. The Bank of England move tonight is going to be something to consider. The considerations for it really are, well, we've already kind of been through them, but to recap, they've still got vaccines going out, but they have one of the best vaccinations in the globe, with an estimated nearly 50% of all adults have already been vaccinated there, or 50% of them at least. We're seeing, the impacts of their economy just starting to kick back up and reopen. So they are pushing very, very hard to go towards that. They have still got stimulus coming in from the fiscal standpoint, although they have already made changes and reform to the taxation side of things and how they're going to recoup some of these stimulus costs. They're not going to be occurring for much further down the track. And we know as well that we are starting to see trade occur for them, at least from a domestic standpoint. Travel is starting to kick back up. Lockdowns are easing. So all of that is very, very positive news for the pound. We've been in a long-term uptrend, which has probably been the result of a lot of weakness in the US dollar. At this stage, we expect the US dollar to continue to weaken. We've seen $240 billion as a part of the stimulus package going out today to about 90 million people in terms of stimulus checks for, those $1,400 checks going out. There's plenty more to go. 242 out of 1.9 trillion is not a lot. So, there's still a lot to come for that. So we're likely going to see more weakness on that side. So I am long on pound dollar and quite happy to have, I've got positions on pound for long already. I have taken one based off this because I've sort of liked the idea of it. There's two sort of areas of support beneath us, plus our zone of support as well. So, a position with a half reasonable sort of stop loss or disaster stop is quite easy to place and give and close to where our entry points are. So that's where I'm sort of sitting on that front. Realistically, I want to see price close above here before I consider taking a position off of this whole pattern. So I am waiting for it to really kick up, the last 50 or 60 pip and close above this point over here. So once that happens, I'm pretty much in on this sort of shape. Now, looking at it from a shorter term perspective, you can see what I mean by when I say increasing, decreasing noise. Daily chart, this looks like a really nice pattern. 4-hour chart, it's still okay. It's a bit wonky. Hourly, you can't tell there's a pattern there at all. So, this is why it's important to sort of look at a few different time frames at varying intervals. It does make the world of difference to us when we're looking at them. So overall, definitely on the long sort of side for the pound. 15-minute charts here. This is a nice head and shoulders pattern. There's the first one. Here's the second one that's a bit wonky. It's like he's got a busted collarbone. And this is the head. Price has certainly moved more than the 20 pip allocated that you would usually run. So it's actually doubled. So you've got sort of a 200% price movement going on there. Right now, if price was to come back down to this point here, then I would consider taking a short position of about 30 pip to try and take. And I'd run my stop loss probably at about 35 to try and come down, to about here, the 1.39. As a bit of a retracement, it is probably due for a bit of a retracement, especially after, a 120 pip move up in today. So, now that we're going into the London session, it will, probably get a bit of stuff on that side to think about. Outside of the, London session, there's not really a lot of news to come and impact that. One at 10 p.m. that would be the ECB president, Christine Lagarde, is speaking. And if she says anything to do with trade related to the UK, then we might see some impact from there. Otherwise, I think a lot of the pricing in for the pound for the Brexit scenario has already really happened. Anything else is going to be something that's probably unforeseen in our sort of eyes or view of things. And of course, there will be some talk tonight about asset purchases. So I am sort of sitting on my hands wanting to see what the Bank of England actually does. I will have some tentative positions in place for in case we do get moved. So I'm going to be using limit orders tonight to sort of see where things go. Obviously, I can pull them on and off as I need. But in terms of the Bank of England, I'm not expecting them to do too much action. They're obviously not going to do anything with interest rates. The only places that they might do something is around the asset purchase programs, which is purchasing bonds. So that's where I'm sort of leaving my eyes or getting a bit of a laser focus going on that side. So that's kind of the gist of my thoughts for this evening. Of course, tomorrow we also have the Bank of Japan, who's going to be talking. So if you are trading any dollar yen pairs, keep an eye on that. Outside of what's going on the dollar yen, in all honesty, I haven't been keeping up to date with the Bank of Japan so much this week. The Fed has been the big piece for me. And the Bank of England has been, I suppose, to some degree as well, but I'm not expecting too much action out of the Bank of England. Bank of Japan, wise, they're starting to ease lockdown restrictions, even though they've got increasing case numbers. They also, have been in a state of what we call, perpetual. Forever. I can't get the word out. My tongue getting tongue-tied. They've been stuck using yield curve control for a couple of years now, and they've also had ultra low rates for a very, very long time. So, that's where we want to see what they're doing. I know on some of the discussion that I have been reading on the Bank of Japan, that the 10-year yield curve is where they're really probably going to be focusing their efforts, perhaps even broadening the range of yield purchases, of bond purchases that they're doing. Instead of, only focusing on the 10-year, they might be starting to look at other things. So I'm just, that's all rumor mill sort of stuff. And I whilst it's a rumor and there is that saying, buy on the rumor, sell on the news, for the Bank of Japan, they do jawbone a lot. So they will say things and not actually do anything about it. And, that's just how the Bank of Japan does things. And I'm kind of waiting. So right now, 4-hour chart wise, we have been sitting in this sort of range right now, which is basically a bit of a breakout for us. We're looking for price. We're the breakout long side, short side, in a slightly upgoing sideways move. So, this is, for all intents and purposes, we've got consolidated price action on this over the last sort of day or so. And we're waiting for this Bank of Japan announcement to occur tomorrow to see where things move next. So that's really sort of where we're sitting right now. And you can just see how choppy it is in the middle. You're getting sort of big spikes and there's no real solid price action to work off. Of course, you could theoretically, if you wanted to just use simple trend lines, you could, sort of do strategies like this where, you're long until price closes, but when it does crash, it takes out on anything you may have made on the way up or down. So, it is very, very choppy sort of behavior in the dollar yen at the moment. And I'm just keeping tabs on what they do tomorrow to sort of establish it. Now, I will wrap it up for the night there. I do hope everyone has enjoyed tonight's session. I know I kind of monologue a bit and talk, but I do have a bit more of a fundamental than a technical view, but I hope it has helped you all. Now, as promised, I will give you a bit of my social medias are up the top there. So if you do want to get in contact with me, you can either send me a tweet or send me a direct message via Twitter, Instagram, LinkedIn, and obviously on our ACY Securities YouTube channel. You can also get in contact with me via talktoal@acy.com. And so don't forget to sort of check out any of those sort of things that if you do have any questions. And if you do want to see me on doing sort of the TV stuff or get some more understanding, then feel free to check out any of the stuff on AusBiz or YouTube as well. But otherwise, I will leave you all for your evenings. I hope you do enjoy your trading days ahead and that it's been helpful for tonight. The next webinar is 7 p.m. Australian Eastern Standard Time next Tuesday. So I will look forward to seeing you all then. And otherwise, bye for now and stay safe.